Hi everyone, it's Amit. So today I wanted to answer the question, how much do you need for retirement? So firstly, if you're actually thinking about this question, kudos to you. And especially if you're in your 20s and 30s, that is just awesome. And the very fact that you're thinking about this early in the game is going to pay off in the long run. Say that if you're in your 20s and if you put $200 to $300 in a month into the equities market, you'll essentially be a millionaire by the time you retire at 65. So kudos to you. Now, if you're in your 40s and 50s, it's still not too late, right? I mean, there's still plenty of opportunity. You may not necessarily get to the same stage as the people in their 20s and 30s when it comes to a retirement, but you also have certain other certainties which could potentially help you through the retirement process. For example, the odds are higher that you will have more visibility and access into Social Security as an example, which could help supplement your income into your retirement days. However, before we go too far into the meat of this video, right, what I wanted to provide a quick perspective into some high-level numbers. So the median 401k balance that people have is right around $60,000. It's a bit under that. So if you were to think that $60,000, right, there is a common rule called the 4% rule. And what the 4% rule basically says is if you extract 4% of your saved amount during the course of retirement, then you'll essentially never run out of funds, right? So when you think about that from this median number perspective of $60,000, you take 4% of that, you're sitting at $2,400. You divide that by 12, and now you've got $200 a month. Can you retire on $200 a month? So from my perspective, obviously, that's where it gets very challenging, right? And it's also demonstrative of how woefully challenged Americans are primarily when it comes to retirement. So how much do you need for retirement? Well, the short answer, unfortunately, like most of these things, is it does depend, right? It depends on your spending habits. It depends on where you live. There's obviously low-cost locales. There's high-cost locales. Taxes depend on the state that you live in. So there is a variety of additional things that need to get contemplated in terms of how much you actually need from a retirement perspective. What I'll cover off in this video is basically 4 rules of thumbs that people essentially use in terms of deriving how much they may need. But as I said, right, the recommendations that I'm providing are primarily from my perspective, right? So when it comes to your specific situation, it is very valuable for you to consult with a financial planner or your own CPA such that they can essentially provide you with more visibility into exactly how much it is that you need. But let's talk about these 4 general strategies, right? Because I think like anything else, they do go a long way, right? And they'll give you some baseline numbers, they'll give you some indication, and if you utilize those, you can at least take those to your financial planner or whomever, and then you can kind of be like, well, this is a gauge, this is what I see, this is how far I am, right? And your financial planners can obviously provide a greater perspective into what that actually means. So let's get started. So the first rule is basically called the 80% of your salary rule. So what that rule basically says is as you're approaching retirement, right, you should have 80% of your salary available annually in your retirement years. So essentially, if you're making $100,000 a year pre-retirement, just to keep this thing relatively simple, you should have about $80,000 a year coming in during your retirement years, and that way you'll have plenty of funds available as you go into retirement. So in order to determine how much you actually need to pay in to arrive at that 80,000 number in this particular example, you can use any of the online payment calculators to come up with that. The second rule of thumb is basically what I call the Fidelity recommendation. So Fidelity is a large brokerage investment advisor firm based in the United States. And what they basically say is if you achieve certain amounts saved for retirement during each of those age groups, you'll have sufficiently enough to essentially retire. Now, what they say is when you turn about 65, you should have 10 times the amount of your salary saved up by then. And then they put a table underneath that, right? So they'll say when you're 30, you should have 1 time as much of your salary saved up for retirement. When you're 40, you should have 3 times. When you are 50, you should have 6 times. When you're 60, you should have 8 times. That's a very useful rule of thumb. Now, I know when you think about it from like a 65, 67 years old, and you're thinking that, oh my goodness, I should have 10 times as much of my salary available during my retirement, that can seem like a very overwhelming proposition. But if you're thinking about breaking it down between 30, okay, 30, I've got a target of 1 times my salary, 40, it's 3 times, and so on and so forth, it makes it a little bit easier. Now, I know there are certain sites out there which will also say, hey, it's closer to 12 times as opposed to 10 times, but that 10 times is basically the recommended amount from Fidelity, if you will. So just to put some numbers around that, right? So if you're making 100 grand a year, when you turn 67, you should basically have $1 million saved up for retirement to live comfortably. The third rule is basically the rule of 25. So what that rule basically says is you take your annual expenses and you multiply it by 25, right? And that should spit out a number, and that number is basically what you need when you hit your retirement age. So if you need $50,000 for retirement, you take that $50,000, you multiply it by 25, it'll spit out $1,250,000, and that is the retirement amount that you need when you turn 65 or whatever age it is that you're looking to retire in. And the last rule, the fourth rule, is the rule of 200. So what the rule of 200 basically says is, okay, you take your monthly expenses of what you expect to have during retirement, and then you multiply that number by 200. Whatever number you get, that is essentially how much you'll have for retirement, or how much you should have saved up for retirement. Then you put all of those numbers into a payment calculator, and it will spit out essentially how much you should have invested into the market to arrive at that particular number. Now, at least for, when you're plugging these numbers into the calculator, I think you can safely assume, 7 to 8% return on the equities market. I've got other videos in terms of investment options and, where you should go and why you shouldn't keep your money in a bank account, an example, or potentially even put it into bond funds and things like that. I'll include a link to that video in the description below. Now, any of these strategies, or deploying any of these strategies, will obviously give you a number, right? My personal recommendation is take the highest number out of all of those 4 models to arrive at your conclusion. Now, personally, I think the Fidelity number is probably going to give you the highest number, but it's worth it to utilize some of the other models as well, just so you have some sense of how much you actually think you will be spending during retirement, as that's going to be very useful in your planning journey. Now, in terms of understanding what are going to be your monthly expenses during retirement, right? So, in this chart that I'm showing here, right, I've basically bolded certain items that I think are most often overlooked, or areas that people have the most challenges in arriving at in terms of how much is actually needed, right? So people are generally pretty good at estimating, oh, I'm gonna have this for my property, I'm gonna have to pay property taxes on it. They also are pretty good at estimating, well, this is my food bill, this is how much I'll probably need for clothing, and so on and so forth. But where they sometimes struggle is, well, what about healthcare, right? And how much should I actually think about from a Medicare perspective? The relevant components of Medicare that we're talking about in this video are specifically Medicare Parts B and D, and I'll have a separate video where we specifically talk about Medicare and its various components. And right now, at least from an estimation perspective, right, you can assume that it's going to be at least $300, $350 a month per person per household. And then just bear in mind that the deductible component is also on you, right? The other part that is often overlooked is the taxes, right? Taxes on your 401k contribution. So in terms of assuming or assessing, well, how much in taxes am I actually going to pay? At least my recommendation on that is just utilize your current tax structure, right? Utilize, whether you're in the 25% bracket, or 37% bracket, or the 20% bracket, whatever it is, just utilize some of those numbers, as they'll give you a close enough approximation in terms of what it is that amount is going to be when you actually retire. The other part that is quite often overlooked is this, this surplus or this miscellaneous fund that I'm asking people to create as well, where I say, hey, you should probably maintain 20% on top just because of things that randomly appear when you enter into your retirement ages, right? So you're going to have some random repair bills on your house, your car, things like that. You may or may not have grandkids. You probably have to give them gifts for their birthdays and Christmas and whatever. So there's all these other things that you need to be cognizant of, and that's where I'm going with the whole miscellaneous component, 20% being a useful estimate just in terms of determining, well, how much is that monthly expense amount going to be when I retire? Now, if you've been following along this whole time, right, there's two things that I've not talked about. I've not talked about Social Security, and I've not talked about pension. Okay, so there's a reason for this. I mean, pension, for most companies at least, have basically eliminated their pension plan. The other part that I've not gone into significant detail on is Social Security, right? I think if you're 50 and maybe if you're 40, 50, and obviously if you're 60, you'll have pretty good line of sight that I'm going to receive some funds when I retire. I don't need to be too worried about the Social Security Administration running out of money. The Social Security Administration will tell you right now, right? They'll tell you that, hey, the money you receive from a Social Security perspective is only meant to supplement your expenses. It is not meant to be, your one source of all your retirement income. And actually, if you're a middle or a high income earner, it's obviously going to make a very small component of exactly how much it is you need from a retirement perspective. And if you're younger than that, it's more unclear, right? It's unclear because who knows what the state of the Social Security Administration is going to be, when you actually achieve retirement age. Now, I think for the most part, people think that there will be some amount available in the Social Security, and most people will be able to take advantage of it. But I think where the struggle essentially becomes is how much is that going to be? Some people say it may be half the amount, right? So maybe it's like $1,000, $1,500, something like that. Some people say it's a little higher. Some people say you should forecast none. So it's just leaving too much to chance, at least from my perspective, right? And that's why I've not spent too much time talking about what you may realize from a Social Security perspective. If you go to the Social Security Administration website, you can obviously they have a calculator there, which will give you an estimated amount that you will hopefully receive when you retire. And I would recommend going to that site. I'll obviously include a link to that below as well in the description. So the question is, well, okay, I've arrived at my number, right? I've used all those 4 strategies that we talked about earlier, right? I plugged them in, I've got an amount, I've picked the highest amount, now what should I do? Well, the first thing you need to do is start investing, right? And I would be heavy in the equities market. I've already talked about that in an earlier video as well. But if you're young and you need to put the money in the equities market, you can derive 7-8+% return on an annualized basis over the long term. You can take advantage over those types of things, and it can definitely be very beneficial. So you need to invest, and you need to invest now. So as you start approaching retirement, right, I think there's certain things that you need to be cognizant of, right? You need to think about, okay, I've got this much saved up, right? Whatever that amount is, I've got this much saved up. Now, is it actually going to be sufficient, or do I feel comfortable with it, right? There's certain things that people do as they start approaching retirement, of which I'll name 2 of, right? One, quite often people evaluate the house that they live in, and they assess whether a downsizing opportunity exists. And the reason for that is if you have kids and whatever, they've essentially moved out, so you may not necessarily need as large of a property as you had during your early years. And you probably, when you have a smaller house, you have lesser maintenance, you have lesser concerns, lesser headaches, if you will, that you need to worry about, right? The second thing you should think about is consider moving. Consider moving to a no income tax state. There's a reason why Florida, Tennessee, Nevada, Texas, they're so common for like senior citizens, right? They go there such that not only is the weather better, right, than some of the northern states, but you can also, they also don't have any income tax requirements. And this is very helpful, right? This is very helpful when you're receiving Social Security funds, for example, or you're withdrawing 401k money when you actually retire. So there's all of these things that are happening, right, which can significantly reduce your cost structure, and you can keep more in your pocket, right? So definitely consider evaluating the state that you're in if you live in the United States. So that's it. I hope you enjoyed the contents of this video. Definitely smash the thumbs up button if you liked its contents, and subscribe. Thank you, and I'll see you soon.